They figure recessions are times to hide, to pull back, to play it super safe. And I get that thinking, I really do. When times get tough, when all the news is bad, when your neighbors are losing their jobs left and right, the natural thing is to hunker down and ride it out. But here's what I've come to realize over 75 years of kicking around the investment world. Recessions are when fortunes get times made asterisk, not lost. Made, I tell you. Let me take you back to 2008, the financial crisis, the worst recession we'd seen since the Great Depression. I remember it like it was yesterday, watching the news on every channel, every single day. It was all doom and gloom. Banks failing, companies going belly up, people losing their homes. It was awful. Genuinely, truly awful. And everybody was scared stiff. I mean, times everybody asterisk. Smart people, seasoned investors, all running for the exits as fast as they could. But you know what I did? I penned an op-ed for the New York Times, October of 2008, smack dab in the middle of the crisis, and the title was, "Buy American, I Am." People thought I'd lost my marbles. Maybe I had, but I saw something they weren't seeing. I saw fear, massive, overwhelming, paralyzing fear. And I've always said, be fearful when others are greedy and greedy when others are fearful. So I bought Goldman Sachs, General Electric, Dow Chemical, Swiss Re. I put billions of dollars to work when everyone else was pulling their money out faster than you can blink. And you know what happened? Those investments did extraordinarily well. They made Berkshire many, many billions of dollars. Not because I'm any smarter than anyone else, because I'm not. But because I understood something fundamental about recessions. They're sales. They're clearance events for good businesses. Think about it this way. If you love shopping at a particular store, and one day they put everything on sale, 50% off, 60% off, 70% off, what do? You load up, right? You buy as much as you can. But with stocks, when everything goes on sale during a recession, most people do just the opposite. They sell, they panic. And that's the opportunity right there. That's where fortunes are made. Now, let me be clear about something here. I'm not saying recessions are a picnic. They're not. They hurt people, plain and simple. Real people lose real jobs. And if you're not prepared, if you don't have some cash saved up, if you're up to your eyeballs in debt, a recession can absolutely wipe you out. That's why preparation is absolutely everything. That's why your strategy matters so darn much. So, let me walk you through step by step how I think about preparing for recessions, how I've been doing it for decades now, and how you can do it too. First things first, cash is king when you're heading into a recession. I know. I spend a lot of time in other talks explaining how cash loses value to inflation, and that's true. It does. But there's a huge difference between normal times and recession times. In normal times, you want to be invested. You want your money working for you. But going into a recession, you want cash. You want dry powder. You want to be ready to pounce. See, when a recession hits, asset prices fall, stocks fall, real estate falls, pretty much everything falls. And if you've got cash on hand, you can buy in at those lower prices. But if all your money's already tied up in investments, you can't take advantage of anything. You're just sitting there watching your portfolio go down, down, down. That's what I mean by dry powder. You need ammunition ready for when opportunity knocks. Now, how much cash should you keep? Well, that's going to depend on your own situation, your age, your income, how much risk you're comfortable with. But I'd say at a bare minimum, you should have 6 months of expenses tucked away in cash. Maybe more if you're older, maybe more if your job's a little less secure. And for investing purposes, you want a completely separate reserve. Money you don't need to touch. Money you can put to work when stocks are cheap. I've always kept large cash balances at Berkshire for this exact reason. People used to give me flack for it. Warren, you're sitting on $100 billion in cash. That's wasteful. Put it to work. But I knew what I was doing. I was waiting for the right opportunity, waiting for the sale. And when 2008 rolled around, I was ready. I had the cash. I could make moves while everyone else was stuck on the sidelines. That's the first piece of the strategy. Build up those cash reserves. Second thing, and this is absolutely crucial, you need to know what you're going to buy times before times the recession even hits. You see, during a recession, emotions are running wild. Fear takes over. Panic sets in. And if you're trying to make decisions in that kind of environment, chances are you're going to make some really bad choices. So, you prepare ahead of time. You make yourself a list. A shopping list of businesses you'd absolutely love to own if only they were a bit cheaper. For me, it's always been about quality. Great businesses, rock-solid balance sheets, competitive advantages, companies that are going to survive the recession and come out even stronger on the other side. I'm not interested in buying garbage just because it's cheap. A bad business is a bad business no matter the price. But a great business at a discount? That's what I'm after. So, you do your homework now, before the recession even gets here. You identify maybe 10, 15, 20 companies you'd just be thrilled to own. You study them, understand them inside and out, get a good feel for what they're really worth. Then when the recession hits and prices start falling, you already know exactly what you want to buy. You don't have to sit there and think about it. You just execute. Let me give you a quick example from my own life. American Express. Back in 1963, there was something called the salad oil scandal. Sounds kinda silly now, but it nearly destroyed American Express. One of their subsidiaries had guaranteed some loans that went south. The stock plummeted. But I knew American Express. I knew their brand was incredibly valuable. I knew people absolutely loved their charge card. I knew that the scandal had absolutely nothing to do with the core business. So, I bought in heavily. I put 40% of my partnership's money into American Express. Everyone thought I was completely nuts. The stock was still falling. The news was awful. Why would you buy more? But I'd done my homework. I knew what that business was worth, and I knew it was on sale. That investment made me many, many times over the years. I bought it and I held on to it for decades. Made Berkshire hundreds of millions of dollars. But here's the key thing. To do that, I had to tune out all the noise. I had to ignore all the fear. I had to trust my own analysis. And that's what I mean about the psychology of it all. You've got to train yourself. You've got to practice this mental discipline now, before the recession, so you can actually execute when the time comes. Fourth part of the strategy, and I can't stress this enough, never, ever, asterisk ever times use borrowed money to invest. Leverage is the absolute enemy during recessions. I've seen more people get completely wiped out by leverage than by anything else in the investment world. Here's what typically happens. You borrow money to buy stocks. Maybe you're buying on margin. Maybe you're taking out a loan. Stocks are going up and up, so it feels perfectly safe. But then the recession hits, stocks start to fall. And if they fall far enough, you get hit with a margin call. The lender wants their money back. So you're forced to sell at the worst possible time, right at the bottom, and you lose absolutely everything. I've never used leverage in my own personal investments. Never. And Berkshire uses very, very little leverage. It's just too darn dangerous. Because here's the thing. Investing is supposed to be about compounding wealth over time. But leverage can wipe you out in a single event. And if you're wiped out, you can't compound anything anymore. Game over. Let me tell you a quick story about long-term capital management. Back in 1998, this was a hedge fund run by some of the smartest folks on Wall Street, Nobel Prize winners on their team. They used massive amounts of leverage. And when things went south, when the Russian debt crisis hit, they almost brought down the entire financial system. Smart people, sophisticated models, none of it mattered. Leverage killed them. So, rule number one, no debt, no leverage. Only invest money that you absolutely won't need for at least 5 years, and preferably longer than that. That way, when the recession does hit, you can hold on. You don't have to sell. You can just wait for the recovery. And the recovery always comes. Always. It might take a year, might take 3 years, but it'll come. Fifth thing, diversification is important, but maybe not in the way most people think. See, a lot of people seem to think that diversification means owning hundreds of different stocks, just a little bit of everything. That way, they figure they're protected. But that's not diversification, that's just confusion. You can't possibly understand hundreds of different businesses. Real diversification, to me, means owning a smaller handful of great times businesses, and making sure they're in different industries. Maybe 10, maybe 15 if you're actively managing it all. But each one should be a business that you truly understand. A business you'd be perfectly happy to own for 10 years or more. A business with rock-solid fundamentals. And they should be in different sectors. So if one industry gets clobbered hard in the recession, your whole portfolio doesn't completely collapse. For example, you might own a bank, a consumer goods company, a utility company, an insurance company, maybe a railroad, different businesses, different economic drivers, different risks. That's real diversification, not just owning 500 different stocks that you've barely even researched. And here's something to keep in mind about recessions. They don't affect all businesses equally. Some businesses actually do okay during recessions. Utilities, for example. People still need electricity, still need water, still need gas. Consumer staples, too. People are still going to buy toothpaste, still going to buy food, still going to buy soap. These aren't exactly exciting businesses, but they're stable, they're predictable, and during a recession, that predictability really matters. So, a smart strategy is to overweight these more defensive sectors as you head into a recession. Then, once the recession hits and the cyclical stocks get really cheap, you can start rotating into those, but you maintain that overall stability. You don't have to panic because you've got a solid foundation of businesses that are going to keep performing steadily. I remember back during 2008, while the banks were collapsing all around me, while the cyclical stocks were getting absolutely destroyed, my consumer staples holdings just kept churning out those dividends, kept generating cash. Procter & Gamble, Johnson & Johnson, Coca-Cola, these businesses just kept doing what they do. And that stability, that consistent cash flow, it gave me the confidence to go out and buy more of those beaten down cyclical stocks because I wasn't worried about my entire portfolio going to zero. I had that stable foundation, that smart diversification. That's how you position yourself to weather a recession. Sixth piece of the strategy, and this is something I learned the hard way. Watch those balance sheets like a hawk. In a recession, companies with a mountain of debt get into real trouble, real fast. They can't make their payments. They end up going bankrupt. And the shareholders get wiped out. So, you want to be investing in companies with really strong balance sheets, low debt, lots of cash on hand, solid credit ratings. I can't even begin to tell you how many times I've seen investors buy a stock because it looked cheap, only to watch it go all the way to zero because the company just couldn't survive the recession. It's not enough for a business to just be a good business. It has to be financially strong, too. So when you're doing your homework, when you're making that shopping list of yours, one of the very first things you should be checking is the balance sheet. How much debt does the company have? What are their cash flows looking like? Can they still comfortably service their debt even if their revenues fall by, say, 30%? If the answer to that is no, just move on. Find a different company. Because here's what tends to happen in a recession. The weak companies don't just struggle, they disappear entirely. And the strong companies, well, they get to gobble up market share. They come out even stronger than before. So you want to own the strong ones, the survivors, the winners. Let me give you a really specific example. Back during the 2008 crisis, I took a long, hard look at all the major banks. All of them were struggling mightily. All of them were down massively in price. But some of them had significantly stronger balance sheets than others. J.P. Morgan Chase, for instance. Jamie Dimon had run that bank conservatively. They had capital. They had plenty of liquidity. So when I started investing in the banking sector, I chose the strong ones, the ones I knew were most likely to survive. And sure enough, some banks did fail. Washington Mutual, Wachovia, a few others, but the strong ones survived, and they came out of that crisis stronger than ever before. That's the importance of looking at those balance sheets. That's why you just have to do your homework ahead of time. Seventh thing, and this is perhaps a little more philosophical, but it's still very important. You've got to think long term. And I mean times long term. Not just months, not even just years, but decades. See, recessions are temporary. They definitely don't feel temporary when you're actually living through them. They can feel like the end of the world, but they're really just temporary. The U.S. economy has been growing for well over 200 years now, and it's going to keep on growing. There will be recessions along the way, that's just a given, but the long-term trend is definitely up. So if you can just manage to think in terms of decades, recessions start to look like opportunities instead of existential threats. Let me put it to you this way. Imagine you're buying a farm, a good farm, productive land, fair price. Now, suppose the year after you buy it, there's a really bad drought. All your crops fail. Farm prices in the area plummet, say 30%. Do you panic? Do you sell the farm at a loss? Of course not. You know that the drought is just temporary. You know the farm is going to produce again in the future, so you just wait it out. That's how you have to think about stocks, too. You're not just buying pieces of paper, you're buying pieces of real businesses. And if they're good businesses, temporary setbacks really don't matter all that much. The long-term value is what really counts. I bought Coca-Cola back in 1988. Since then, we've been through several recessions. The tech bubble, the financial crisis, the pandemic. Did I sell during any of those? Nope. Because I bought Coke for the long haul. I bought it because I truly believed in the business, in the brand. And today, that investment is worth many, many times what I originally paid for it, just because I didn't panic. I didn't sell. I thought long term. You know, one of my favorite quotes is from my teacher, Ben Graham. He said, "The stock market is a voting machine in the short run, but a weighing machine in the long run." What he meant by that was that in the short term, stock prices are mostly driven by emotion, fear, greed, panic, euphoria, all that jazz. But in the long term, stock prices actually reflect the true value of the business, its earnings, its cash flows, its fundamentals. So, if you're a long-term investor, you don't really need to worry too much about the voting machine. You just focus on the weighing machine. You focus on owning really good businesses, and you just let time do its thing. Eighth piece of the strategy, and this one is maybe the most important of all, live below your means. Always. Not just during recessions, but always. Because if you're living paycheck to paycheck, if you're spending every single penny you make, you can't save, you can't invest, you can't prepare for anything. And when the recession hits, you're incredibly vulnerable. One missed paycheck and you're in deep trouble. I've lived in the same house since 1958. The same house. It's a perfectly nice house. Don't get me wrong, but it's certainly not a mansion. It's not extravagant in any way. I drive a pretty regular car. I don't own a yacht. I don't collect expensive art. And it's not because I can't afford those things, because I certainly can. It's just because I don't need them. They don't really make me happy. What makes me happy is security, financial security, the knowledge that no matter what happens in the world, I'm going to be okay. My family is going to be okay. And that comes from living below your means, from consistently saving more than you spend, and from investing the difference wisely. So, if you take absolutely nothing else away from this, take this. Live simply, save aggressively, and invest wisely. Do that, and recessions will become opportunities instead of disasters. Now, let me tell you a little something about lifestyle inflation. This is a trap that I see people fall into all the time. They get a raise, they get a promotion, and immediately they start upgrading their lifestyle. Bigger house, nicer car, more expensive vacations. And suddenly, they're not saving any more money than they were before. They're just spending more. The smart thing to do when your income goes up is to keep your lifestyle pretty much the same and save the difference. That's how you truly build wealth. That's how you prepare for recessions. I've known so many people over the years, high earners, doctors, lawyers, executives, making hundreds of thousands of dollars a year, but they've got absolutely nothing saved because they spend it all. They live right up to their income and sometimes even beyond it. And then, when a recession comes along, when they lose their job or they have to take a pay cut, they're in a full-blown crisis because they don't have any kind of financial cushion. Don't be that person. Build your cushion. Build your reserves. Live like you make half of what you actually make and invest the rest wisely. That's how you get real financial security. That's how you sleep well at night. Ninth thing, and we're getting near the end here. Stay informed about what's going on, but don't obsess over the news, especially during a recession. See, the news media, they make their money from getting your attention. And fear gets attention, panic gets attention, so during a recession, every headline is going to be all doom and gloom. Every story is going to be about how bad things are. And if you're watching that stuff all day long, reading that stuff all day long, it's absolutely going to affect your judgment. It's going to make you scared. I definitely read the news. I stay informed about what's happening, but I don't let it dictate my decisions. I focus on the fundamentals. What are the businesses that I own actually doing? What are their earnings looking like? What are their long-term prospects? That's what really matters, not what some talking head on TV is saying. So, my advice is to limit your news consumption, especially during a recession. Check in once a day, maybe just quickly scan the headlines, but don't obsess over it. And whatever you do, don't sit there watching those financial news channels all day long. That's just a recipe for panic. Trust your preparation, trust your research, trust your long-term strategy, and tune out all the noise. I remember back during the dot-com bubble, in the late 1992 and early 2000s, everyone was telling me I was wrong, that I was missing out on all the action, that I just didn't understand the new economy. The news was just full of stories about internet stocks and day traders making millions of dollars and people quitting their jobs to trade stocks full-time, and I just ignored it all. I stuck to what I knew. I focused on businesses that I truly understood, businesses with real earnings. And when the bubble finally burst, when those dot-com stocks fell by 90%, 95%, I was perfectly fine. More than fine, actually, because I hadn't gotten caught up in all the mania. That's what I mean by tuning out all the noise. The media loves to create narratives, and those narratives can sound very seductive. They can be very convincing, but they're also often wrong, especially at the extremes. So stay informed, but always think for yourself. Don't let the crowd do your thinking for you. 10th thing in this strategy, understand the critical difference between price and value. This is absolutely fundamental. This is something that Ben Graham taught me when I was just starting out. Price is what you pay. Value is what you get in return. During a recession, prices tend to fall. Sometimes they fall quite a lot, but the underlying value of good businesses, that doesn't typically fall nearly as much. So you end up with this gap, this disconnect between price and value. And that right there is your opportunity. Let me explain it to you in another way. Imagine a business that consistently earns $10 million every year. In good times, the stock market might value that business at, say, $150 million. But during a recession, the stock price of that same business might fall all the way down to $80 million or even $60 million. Even though the business is still earning pretty close to that same $10 million every year, that's the gap right there. The price fell, but the value didn't fall nearly as much. And if you can manage to buy when that gap is really wide, you're likely to make extraordinary returns when that gap eventually closes, when the price and value converge again. That's value investing in a nutshell. That's what I've been doing my whole entire career. And recessions just create some of the widest gaps, and therefore the very best opportunities. So you've got to train yourself to look past just the price and to really focus on the true underlying value. What is this business really times worth? What is it likely to earn over the next 10 years, or even 20 years? If you can answer those questions with a reasonable degree of confidence, then the current stock price doesn't matter quite as much. You know what you're really getting for your money. 11th part of the strategy, and this is something I don't talk about quite as much, but it's still pretty important. Have an exit strategy in mind, but not the kind that most people think of. I'm definitely not talking about selling out when stocks fall, and I'm certainly not talking about cutting your losses. What I mean is, have a well thought out plan for how you're going to use the money that you make from investing during the recession. See, when you buy stocks during a recession and they eventually recover, you're obviously going to have some pretty significant gains and maybe even substantial gains. What are you planning to actually do with all that money? Are you going to take those profits and maybe reinvest them in something else? Are you going to diversify your holdings? I personally tend to hold on to my investments pretty much forever if the business is truly great, but some people prefer to take their profits and rebalance their portfolio. That's perfectly fine, too. The most important thing is to have a plan in place. Know what it is you're ultimately trying to accomplish. Are you building wealth so you can retire comfortably one day? Are you trying to save for your kids' college education? Are you simply aiming for complete financial independence? Whatever your ultimate goal is, let that goal guide your decisions along the way. Because just investing without any real goal in mind is basically just gambling. You're just kind of playing around with your money. But investing with a crystal clear goal in mind, and with a carefully thought out plan, that's how you truly build lasting wealth over the long term. 12th thing, and this might actually surprise you a little bit. Don't waste your time trying to time the recession perfectly. You simply can't do it. Nobody can. I can't tell you exactly when the next recession is going to start, and I certainly can't tell you when it's going to end. I can't even tell you exactly when the right time to buy is going to be. What I can tell you is that when stocks are down 30% or 40%, when fear is running rampant, and when everyone else is panicking and running for the hills, that's generally a pretty good time to start buying. You absolutely do not need to try and hit the exact bottom of the market. In fact, trying to time the exact bottom is often a huge mistake, because you'll end up waiting and waiting and waiting, always trying to get that perfect price. And by the time you're finally completely sure that the bottom is truly in, the market will likely have already started to recover, and the best opportunities will already be gone. So, my personal approach is to just start buying when things are clearly looking bad. When stocks are obviously cheap, buy a little bit, then if they go down even more, buy a little bit more. And if they go down even further than that, buy even more still. That way, you're averaging in over time. You're not trying to be perfect, you're just steadily taking advantage of the sale. And over time, as the recovery inevitably happens, you're likely to do very, very well. Remember, perfect is the absolute enemy of good when it comes to investing. Don't try to be perfect. Just try to be smart. And try to be disciplined. That's perfectly good enough. More than good enough, in fact. 13th part of the strategy. Learn as much as you possibly can from history. While every single recession is definitely different in some ways, with its own specific causes, its own level of severity, and its own particular duration, there are definitely some underlying patterns that tend to repeat themselves. And there are also always valuable lessons to be learned. So study past recessions. Read as much as you can about them. Really try to understand what happened, what seemed to work well, and what definitely didn't work at all. The Great Depression, the stagflation of the 1,970 seconds, the stock market crash of 1,987, the dot-com tech bubble, the 2008 financial crisis. Each and every one of them has important lessons to teach us. Each one shows you some of the things you should definitely avoid doing, as well as some of the things you should absolutely be doing. For example, back during the Great Depression, the people who held onto their cash tended to do pretty well because deflation actually made cash become more valuable over time. But on the other hand, in the 1,970 seconds, the people who were holding on to cash got absolutely destroyed because high inflation made cash essentially worthless. So the overall lesson here is that context really matters. You need to really understand what kind of recession you're currently in. Is it primarily deflationary? Is it inflationary? Is it mostly a credit crisis? Or is it perhaps a demand shock? Different types of recessions might require slightly different approaches, but the core underlying principles still generally remain the same. Always try to own good businesses, and always try to buy them when investors who are fearful, tend to think with a long-term perspective, and it's vital to stay disciplined. These principles are effective during any recession, every single one. So, examine past events, gain knowledge from them, and avoid repeating past errors. The 14th point, and this is absolutely crucial, is to have the courage to take action when the opportune moment arrives. This is where most individuals stumble. They possess the required knowledge. They have developed a solid strategy. They even have available cash. But when the recession actually hits, when stock prices are plummeting, when everyone is feeling fearful, they freeze up. They find themselves unable to pull the trigger, unable to bring themselves to buy because it just feels instinctively wrong. It feels downright frightening. It feels akin to attempting to catch a falling knife. But that's precisely the time when you need to act decisively. That's exactly when you need to conquer your anxieties and execute your meticulously planned strategy. The only proven way to accomplish this, the only method I've discovered, is to mentally prepare well in advance. Visualize the scenario. Imagine the recession unfolding. Picture the stock market plummeting. Conjure up the feeling of widespread fear. Then, visualize yourself maintaining composure, adhering to your pre-established plan, and buying when the majority is selling. Practice this mental exercise repeatedly. By doing so, when the actual event occurs, it won't be unfamiliar or shocking. You will have mentally rehearsed it. You'll already be well versed in the actions you intend to take. This is what mental preparation entails. It's how you cultivate courage. And this courage is the key differentiator between those who accumulate wealth during recessions and those who merely observe it happening from the sidelines. The 15th and final component of the strategy is to exercise patience. For most people, this proves to be the most challenging aspect. Patience lacks excitement and drama, yet it's paramount in investing, particularly during economic downturns. You see, when you acquire stocks during a recession, their value doesn't immediately skyrocket. They tend to fluctuate. They might even decline further before they eventually rebound. This tests your patience and your resolve. However, if you've diligently done your homework, and if you've invested in sound businesses at reasonable valuations, then you simply need to exercise patience. The recovery will inevitably materialize. The businesses will eventually thrive. And ultimately, the stock prices will mirror that growth. Although it might take time, sometimes spanning years. I often equate this to planting an oak tree. You sow the acorn, provide water, and protect it, but you refrain from excavating it weekly to monitor its growth. You simply allow it to flourish. And one day, several years down the line, you'll be rewarded with a magnificent oak tree. This is akin to investing during a recession. You plant your seeds, safeguard them, and exercise patience. If you can embrace this approach, if you can cultivate patience, you'll undoubtedly reap the rewards. Now, let me consolidate all of this for you. Recessions are inevitable. I'm uncertain as to when they will occur. Nobody can predict the precise time.